Well, it's that time of year again. If you are an investor, you need to pay attention on how to plan out your tax strategies. So we thought we'd bring in Mark Kohler, who is a CPA, attorney, business expert, who specializes in tax and legal strategies for small businesses, asset protection, wealth building. And of course, we are always up against figuring out how to mitigate our taxes. And we thought we'd bring in Mark for a year-end tax tips strategy at the end of 2025. Mark, great to see you. Welcome back to the show.
Oh, thanks for having me. And yeah, this is the time of year I want to deliver some Christmas gifts here. So it's a season of giving. You're welcome, everybody.
Well, I know, and my wife and I have these same strategies. We sort of hit our heads against the walls. We're sort of planning throughout the year, and we're like, why didn't we think of this? It seems like every year we're kind of going through this. So maybe before we get into, we'll talk about some like top 10 tax strategies here. Before we do that, though, what do you think are some of the biggest, most important changes that we've seen, maybe under this new Trump administration, leaving the disaster of the Biden administration behind?
Well, one big beautiful bill is beautiful. And there's a lot in there. What felt a little lackluster for a strategy, guys, was it was really a continuation of the Tax Cuts and Jobs Act. We were like waiting for something new that, Congress or Trump was going to pull out of his hat, but it was really just the security and comfort that we're going to extend all those beautiful provisions from the Tax Cuts and Jobs Act. We got the 100% bonus depreciation. I'm really excited about the opportunity zone policy that's going to, the year 2026, all the governors are going to be deciding their areas that they want to focus on for redevelopment. And then in 27, we're going to see a really big boom on that tax strategy. But really a lot of the same, but that doesn't mean there's not more opportunity for planning. There's always areas to save some money.
Well, let's get into it then. Let's get into some of your top 10 strategies here for year-end tax planning. Where do we start?
You bet, Clayton. I wish I could have dropped some golden nugget from the one big beautiful bill, but there's a lot buried in there, and it's a lot of fun to plan.
Well, actually, I guess before we do that, then, so you bring up an interesting point, because I know, like, I have friends in the solar industry, and this big 30% tax cut is expiring on December 31st, but my friends in the solar industry believe that Trump is about to pull maybe a rabbit out of his hat. And we've been talking to our tax team, of course, about, what you can do on different investment strategies, getting solar put on buildings and so forth to take advantage of that 30%. That he thinks that maybe even Trump's going to pull out a 50%. But who knows what Trump's going to do next year with that, but because he's got a lot of friends in the solar industry. But anything on solar that you're kind of keeping your eye on?
Well, Clayton, it's interesting you say that, and we should have a show dedicated to that in the Q1, because there's actually a lot of concerns with that strategy. Fundamentally, the tax credit's wonderful. Solar's great. Let's help people mitigate disruption in their utility bills and reduce costs. But once you start trying to sell that solar tax credit to an investor that's not really materially participating in the project, and they cook up ways for it to happen, it is a huge audit risk. So I know that's dropping a bomb, but I've got to say it. I've had a lot of concerns about the solar tax credit for the investors and the promoters out there trying to sell it to someone that lives in Florida for a solar tax credit in California, that they're really managing a solar leasing company. Give me a break. And anybody want to go toe-to-toe on that with me? Bring it.
Wow, interesting. All right, well, that's a good warning. Well, let's get into it then. Let's get through some of the top 10 strategies that people can employ maybe right now here in mid-December before the end of the year.
You bet. And this is our busiest time of the year. April 15th, I'm golf. I don't care. Because you can punt. This is the buzzer beater, guys. Everybody, it's on December 31st. Well, we need to make a distinction right out of the gate. There's those that have a small business and those that don't. And so if you're a W-2 wage earner, corporate America, which is fun, wonderful, great. There's a lot of benefits that come with that. Stable income, we hope, and benefits. And a lot of times we can clock out at 5 or 6 unless you have a very demanding job. But it's not your business you're married to 24/7. Those are your benefits. I hate to tell you, cons, there's not a lot to offer. Tax strategies for the corporate America W-2 wage earner are few and far between. I've got 2 or 3 we'll mention. But then we've got the business owner. And there's 40 million Americans now with the side hustle. 1 in 3 Americans get a 1099 from somewhere, whether it's internet sales, eBay, selling something on Etsy, services, consulting, and NIL. All the athletes that are out there making money in NIL, those are 1099s. So That small business world, I got a 20-point checklist of strategies that save you thousands, but you give me something to work with. And I'm not saying having a small business is better or not demanding and takes some work, but for tax planning, the world is my oyster. So got a few there I can throw down too. So you get to choose. So we'll talk business owner first or W-2.
Let's do business owner first. Sure.
Okay. So on the business owner side, and I'm going to go straight to one of my biggest calls to action, and I think you're going to love this thing. I am also, you're going to, as you know, I'm pretty angsty and dramatic. I am so sick and tired of these financial planners and advisors out there that say, yeah, once you have 100 million, you could have a family office. Hire me to be your family office. We'll do your family office. It's bullcrap. Every small business owner in America has a family office. It just happens to be 3 doors down the hallway with a hide-a-bed in it. But you get to have a family office too. You should be having your family board meeting. Family members should be on the payroll for doing the legitimate services, whether they're under age 18 or over age 18. And I'm not talking it has to be a W-2 either. But our families in America need this. They need to teach their families financial literacy. They need to talk about money. They need to talk about their business. And it's called the family board meeting. And it's a tax deduction to have that meeting. The holidays are perfect for this. I want you writing off travel, dining. You're going to have a meeting that gives you better asset protection, better tax strategies that protect you in audit. I could go on and on, Clayton. But my challenge to everybody out there with a small business, even if it's a 1099 driving Uber, have your board meeting and take a tax write-up, even if it's going to, Olive Garden for dinner.
So we'll get back to that in a minute. But first, let me ask you something. Is your money actually safe and growing? Because if you're keeping it in a savings account or a CD, you already know the answer. We say that savers are losers because the United States government cannot stop itself from deflating the US dollar. They just lowered interest rates once again, which weakens the US dollar. The stock market? Well, that's another way to send your portfolio off a cliff because, again, that's a partnership with Wall Street and the government. That's not a strategy, that's gambling. So for years on this show, we've talked about building real wealth with real assets like real estate. And one of the simplest ways to do that is through a platform called Connect Invest. Now, you're not buying stocks, you're not speculating, you're investing in real estate with short notes that are backed by real, tangible properties and that deliver fixed monthly income and annualized returns up to 9%. Yes, you heard me right, 9%. So instead of buying a whole property, you're buying into a fund that buys properties. There's no volatility, no drama, just predictable monthly cash flow. You're investing with other real estate investors in small investor groups. It's not a REIT or a BlackRock type of a deal. So check it out for yourself at redacted.inc/invest. We'll have the link right here on the screen. Redacted.inc/invest. You create your free account and then you fund your digital wallet to start investing with as little as $500. If you have a few $1,000s or a few $100 in your savings account and you want to actually start earning 9% returns, now is your chance. And if you sign up now, you'll get a $50 bonus wallet credit with your first interest payment. So check it out right now, redacted.inc/invest. So just to be clear on that, because we do that with our family. We've got our kids who are involved in the business and so forth. When you have a board meeting, you're talking about like at the house, Olive Garden, some other place, just even having like a dinner meeting as a write-off. It'd be like a small write-off, but is there some bigger write-off that I'm just unaware of?
Yeah. And I don't know the age of your children, but some of you might have an 18-year-old or 25-year-old. They're coming home from college. I'm sorry, did you fly in your kids for Christmas? I thought you said you flew in your board members to have a board meeting.
Interesting.
I'm sorry, did you say you were going to Park City to go skiing? I thought you said you were going to Park City for 2 days to have a board meeting. People take advantage of this and have a real meeting. You should have accountable plan provisions in those minutes. You should be having asset protection conversations. What is your structure for next year? And telling your kids what you're doing and why you're working so hard. Kids don't understand that. They want to see it. They need to see it, especially those teenagers and college students. They're starving to learn what you know.
That's great. Okay, great. Because we actually have a family event coming up here right before the holidays. And, oftentimes we're talking about all of this stuff anyway. So Now just make it more structured, make it more legit, make sure you're having an accounting of it, writing down your minutes and who was at the meeting and what you were talking about. And that's brilliant. That's brilliant.
Well, and we could focus. I'm feeling it, Clayton, because I'm rather than just shotgun a few strategies, and we can list a few here at the end, but let's, if we could, just unpack this a little further.
Yeah.
People, having a rental property is having a business. So if you've got a rental property, and millions of Americans do, or even rent it to their own business, or commercial, short-term rentals, long-term rentals, all the above, that's a business. So your LLC needs to have a board meeting. It's called a board of advisors. Every operating agreement we set up at our law firm has a board of advisors. Now, some of you have one sheet of paper from LegalZoom 3 years ago. That's not a freaking LLC, people. Good luck in court. Good luck in an audit. Have a legitimate meeting for your LLC. Keep track of your corporate book. Have conversations and talk about investing. Talk about real estate. Talk about what ROI means and cap rates and how you can start a Roth IRA, or all these conversations are so important. And the business gives you the avenue. It gives you that conversation point so the kids feel like they're a part of something. Don't make them owners, just put them on the board.
Great point. All right. Yeah, like my wife and I just the other day had a lunch meeting, and the whole lunch was all about business. So we wrote it on the receipt. We talked about this, we talked about that, and we just had a working business lunch, and so that goes right in there. But people just sort of forget that sometimes. Okay, next strategy, Mark.
Okay.
These are great.
So right on the tail end of that, and we'll stay with business owners here for a moment, because I know a huge swath of your listeners are having that side hustle, small business, at least supplementing their day job. Your family members should be on the payroll. Now, I use that term loosely. My kids over age 18, they all get a 1099 because they're helping in the business, whether it's a little marketing this, they're going to an event, we're having conversations, I'm getting advice from what they're learning in college or their own careers. Our kids are a part of, I hate to bring up the show Succession because you hate everybody on that show by 3 episodes, but right. It's the same point. You need to be talking to your kids. So my kids that are 18 and older get a 1099 for attending the board meeting. I don't pay my kids' college tuition. I pay them for serving in the business, and they pay their own tuition. I just got 100% write-off for tuition. So my kids are in a lower tax bracket, if any tax bracket at all, and they got the same federal standard deduction I do. And so at Christmas, it's so special, Clayton. You'd love it. You come down, there's a Christmas tree. It's Christmas morning. My kids go to their stocking. There's $10.99. I mean, they love it. It's a really special gift. They all know how special it is. And then they go to the Christmas tree, and what's in there? There's a box. They unwrap it, and there's a receipt for their Roth contribution. You're welcome, kids. There's your Roth. There's your 1099. Enjoy your life.
You're an old sentimentalist. Exactly.
Yeah.
Tape
they think it's a lump of coal. It's a diamond in the rough.
I know. Tape a candy cane to the front of it. I love that. All right. Keep going, man.
All right. So we want to get our kids on compensation. So if your kids are under age 18, you're going to have a little different structure. You can pay them out of your rental property LLC. You can pay them out of your S Corp through a little support company. This is all in my books, and I've got all these podcasts and videos on these things on YouTube. So talk about paying your kids under age 18, over age 18, Kohler, plenty of content out there. Number 3, if you're a small business owner making more than 50 grand a year, you're an S corporation. And if you're not, you're a candidate. That may mean backdating your LLC to an S Corp for 2025, and you've got to dial in your payroll in the next 4 weeks. We've got to make sure turning the corner into the first week in January, you're taking reasonable comp, but not too much. And accountants force business owners to take way too much salary all the time. This is not high risk to take a lower reasonable comp, push out more money on your K1. You're saving FICA. I hate the F word, FICA. What the FICA? And so we want to reduce that FICA, take reasonable comp. And do we put our spouse on payroll? Should we not? Don't do it for Social Security. They're going to get the spousal benefit anyway. So we've got to be really crafty with that S corporation. And there's 13 million S corporations in America today. And many of you listening now, you're in control of your S corp, not your accountant. Learn about reasonable comp, study any of my material. I've got a payroll matrix to help point the way. This has all got to be done. Your compensation, your spouse, your kids, your board meeting. Guys, there's $10,000 in tax savings sitting right there.
Damn.
Boom. Where's my pen?
This is great, but you're also pissing me off. But
sure. This happens sometimes.
I know.
Well, let me throw you another lifeline. Here's another cool one. As a small business owner, we want to be buying rental property. Absolutely. We want to be taking home office. Do not be afraid of home office, people. We want to be taking the auto, the travel, especially around our board meetings. And knowing you, Clayton, you might have 2 or 3 board meetings a year. You got a lot going on. That's okay. Document it. The more money you make, the more you can write off. But the next piece is funding your own 401k. In the One Big Beautiful Bill, all right, here's a cool one I could drop. In the One Big Beautiful Bill, there is a new tax credit that if you auto-enroll your employees, the government's going to give you a $1,500 tax credit. That's like a $3,000 deduction, maybe $4,000 deduction. It's $500 this year, $500 next, $500 in the third year. It's even for small business owners to set up a solo 401k. Now let me say why.
When
this
you said auto, just to be clear, auto enrolling your employees in what?
Okay, 401k. So
401k.
Yeah, here, and this is interesting, Clayton. You're going to love it. In America, we suck at saving. We are not good savers. 40% of people that could participate in a 401k at work don't even participate. And if there's a match sitting right there, 100% return. Just put in $3,000, $2,000, and the company will match it. 40% of Americans don't even participate. Drives me crazy. So what in the One Big Beautiful Bill, Congress said, we've got to help take this burden off Social Security. So we said to business owners, if you auto-enroll your employees, because they're not signing up to do it, we're going to auto-enroll them. They have to actively get out, which is a difference. Rather than actively get in, you have to actively get out. So millions of Americans will just say, oh, okay, I guess I got to do it. So the government said, if employers, you do this, we'll pay you. We'll give you a $1,500 tax credit just to get your employees involved. It's crazy. But here's
I remember when this rolled out initially. I don't know that there was a tax credit for it at the time, but you would know better than me. A number of years ago, like Home Depot, they auto-enrolled people right away. And I don't know that there was the tax benefit back then, about 5-6 years ago, whenever this started coming out. But now they've added on this incentive, because I remember Home Depot was just like auto-enrolling all of these new employees in their 401k program.
Yeah. Home Depot has a great reputation of caring for their employees, and I love that. And some employers would do it and say, we know better, trust us. But this is a new incentive. Now, here's the loophole. With a solo 401k, we charge $1,000 to set them up. You get your own solo 401k. You can dial up a $20,000 deduction of $40,000, do your Roth IRA, and then play in your own solo 401k, people. You're the only employee, so you can dial it up or down all you want. You can match up to 25%. But here's the loophole. If you auto-enroll yourself, you still get the tax credit. The legislation was silent on solo 401ks. They were really trying to get the big companies to auto-enroll everybody. But the little standalone small business owners like, hey, I'll auto-enroll myself. Can I have the credit? There it is. So
Wow.
You're getting paid to open a 401k now. You make money setting it up.
Damn. All right. I got to do this now. Another laundry list of things to add to my to-do list. Thanks, Mark. All right. You're on fire, man. Keep going.
Okay. Let's jump to medical. Now, medical, number one cause of bankruptcy in America, healthcare costs. It's killing people, and premiums continue to climb. We don't even go there, right? Huge conversation.
Yeah.
But what can we do on our tax return? Well, there's three main strategies, and this is where we can get back to corporate America. I could throw you a lifeline, everybody. But there's three main strategies. The flexible spending account, which is the use it or lose it, right? Companies will say, oh, you got $2,000, turn in your receipts before you're in, you'll get reimbursed tax-free. Use it or lose it. That's a flexible spending account. If you have one of those in corporate America, use it. Don't lose it. There's your tip. You've got 3 weeks to turn in your receipts. So, some companies will give you a grace period, but don't plan on it. Get your receipts in. It's free money. Then there's the health savings account and the health reimbursement arrangement. Health savings accounts, I think they're more powerful than a Roth IRA. You get a tax deduction to put money in on the front page of your return. There's no income phase out. I can make $1 million a year and still take the freaking write-off. It's $8,500 this year if you're a family or head of household, around $4,250, whatever, if you're single. That's on the front page of your return. It grows tax-free and it comes out tax-free for anything medical. And you don't have to wait till you're 59 and a half. It's like a tax-free ATM for medical expenses.
And that's per person in the family? So if you've got a family of 5, $8,500 per person or total?
$8,500 for the family. But once your kid turns 18 is out, they can have their own. So it's single individuals, about 42.5. I could get the right number in the transition of 25 to 26. But yeah, it's about 42.50 or 8,500 is the deduction.
Now, we're a family. We don't have health insurance. We use crowd we use crowdfunding, crowdsource healthcare.
Health caring sharing ministry. Yep. The
Yeah.
sharing ministry.
Yeah, and so it's
Yep.
been great. I mean, my son had to go to the emergency room earlier this year for like a migraine thing, and they took care of all of it. You know, it's pooled and everything. So when they ask you and you're checking out, like, who's your health insurance? We're like, we don't have it. And then the cash, we're just paying cash, and it's crazy how cheap the bill is compared to you actually having health insurance. But even under that structure, this would still apply, right? Because we would be setting up our own sort of health savings account in case of an emergency, basically.
Well, it's a great question because it brings me to the only requirement to have a health savings account is you have to have a high deductible plan. Now, and the healthcare sharing ministries don't qualify as real insurance because you can't write off the contribution to your share group, which is great. And let's back up for everybody here because what Clayton dropped here was an interesting strategy it's not talked about enough. Groups got together. It started with mega churches and others. You don't have to be Christian or whatever. It's just the term. This healthcare sharing ministry is everybody got together and created a fund. And let's just say, hey, let's all pool our money together, cut out the insurance company, the middleman, the evil insurance company, and we can cut our insurance premiums by 40 to 60%. Then when you need to go to the hospital, the doctor, you cash pay, you negotiate for better services. You get to choose any doctor you want. There's no network crap. And that's what you're doing, Clayton. I am actually pretty impressed. They're pretty rare out there.
When we moved back from Europe, we moved from Portugal last year. We said we don't want to get health insurance like $2,800 a month, which is ridiculous. And one of the sponsors of our show, we actually started called Crowd Health. So I'm not they're not a sponsor of my show or anything like that anymore, but they're fantastic. I know the CEO, and their whole philosophy is like one of their big philosophies is, hey, why should you have to support vegans? Which their data shows overwhelmingly, if you're vegan, like you're going to have the most health problems. I know that's like counterintuitive to a lot of people, but of course that's been buried. So they even have like a higher tier. Like if you got a DEXA scan to show that your like visceral fat was low, you would even pay way less. So my wife and I went through that whole process and got a DEXA scan, and so they're like, why underwrite vegans? Like they're going to have the highest health problems. And I was like, I love this guy, I love this company, and so that's who we use, this Crowd Health company, and we pay like $200 a month or something. It's crazy. So
and so everybody knows that the pro and con of that is obviously Clayton's got a much lower quote unquote premium, and he's got a very flexible plan that aligns with his belief systems and what they want to pay for and what they don't. The con is it's not a write-off to put money into those. And number two, if you have a catastrophic issue, those big group sharing plans can have problems because it could break the back of the plans. You have to look at the fine print. And then third, pre-existing conditions can be an issue. Not all these crowd plans take pre-existing because they're signing up for a lot of stuff. But they can work for certain families, and it works for you.
Yeah,
but
exactly.
Back to the health savings.
Do your own homework on it, basically.
Yeah. And I love that you're doing that. And it's a good conversation point. But the health savings account says, hey, if you're healthy like Clayton, that's cool. Go get a high deductible plan. And when you get the higher deductible, your premium starts to nosedive. But these insurance companies don't want to offer that because you self-insure yourself. You're paying a lower premium for something catastrophic that could happen. I got a high deductible, $5,000, whatever. And some of you are like, $5,000 deductible, Mark. I'm like, you don't even go to the doctor. What are you bitching about? It's okay,
Right.
And so if you're not going to the doctor, take the savings, drop it into a health savings account. Grows tax-free, comes out tax-free. You get a write-off. You can invest it in gold, crypto, real estate. I own a rental property in my health savings account. Grows tax-free, pays for dental, optical, co-pays, deductible, pharmacy, anything. It lasts your whole life. It's portable. Take it anywhere. These health savings accounts freaking rock.
That's awesome. Okay, I'm going to look more into this. I'm going to have a discussion about this with my wife. Okay.
Now, why is it a year-end tip? We're in enrollment period, people. If you don't select your health insurance for next year by January 1st, the grace period is January to be effective February 1st, I've got to set up my health insurance selection in the next 4 to 5 weeks for 2026. So millions of small business owners, they don't have some enrollment period at corporate America. They have to do it during November 15th to January 15th. November 1st to January 15th. So right now we're in the throes of deciding, are you going to get a deduction next year? What's your premium going to be? What insurance do you want? People, you are the captain of your ship. Get on the healthcare.gov, get in your state network, call an independent insurance agent. Here's the takeaway. If you're healthy, look at the high deductible plan and self-insure yourself, much like Clayton's doing with the group, but self-insure yourself with this HSA, like a Roth IRA for medical. And you take it anywhere you want. It's all your money, and you can invest it however you want.
Love it. Doing it. Yeah, we're going to look into this structuring, so thank you for that. All right. We got a few more tips here before we get you out of here, Mark.
Okay. We're going to stay with some of the things that we're going to stay on medical. Let me finish that HRA, health reimbursement arrangement. An HRA is for small business owners, so we're back into that category. But let's say you're not that healthy. You have a lot of medical expenses. A lot of Americans, especially young people, think, oh, well, I get to write off my medical expenses. No, you don't. You can try to itemize them, but they phase out at 7.5% of your AGI. So if you make $100,000, you can't even write off your first $7,500 of medical expenses. And you've got to itemize, which is, you got the SALT problem with the state and local tax limit. Are you putting that much money in charity? Most people are now going to the standard deduction. So the point being is 97% of Americans try to write off their medical itemized, no write-off. Because if you had $8,000 in medical with $100,000 of AGI, you could write off $500. You could write off anything above that 7.5% floor. It's terrible. Well, the HRA, sorry everyone, for small business owners says, well, I'm going to give my employee, maybe my spouse, an health reimbursement arrangement and cover all. That's their compensation. I'm going to cover all their medical and their dependents, which includes me. So now I can set up a reimbursement plan, fully deduct all my medical costs, and it's tax-free to my spouse, and it covers the whole family. If you're single, we have a different entity structure to build that out. But it's very common. It's called the HRA 105 plan. Been around for 40 years. But again, CPAs and accountants don't talk about this enough. It drives me crazy. And so if you're a small business owner with high medical, put on your checklist the 105 plan. And guess what? You got to have it in place before December 31st for 2025. So get on it.
Great. All right. I guess so we covered a lot on the small business side, but I'm thinking like for investors, and obviously that's still part of it, right? If you're an investor, you're a small business owner, you have an LLC, you're investing in real estate. But maybe just on maybe owning real estate or owning precious metals or anything like that. Is there anything that we could do at the end of the year here?
Yes. And I like the way but let's create another category here. So when everybody listen, when Clayton says investor, there's two types. Marketable securities, crypto, Wall Street investors, that's not a business. That is passive income. IRS has said you cannot even write off your home office against that. That is not a small business. You are an investor in passive marketable securities, we'll say, crypto even. But if you own rental real estate, which I love you created that caveat, investors that own rental property, that is a small business. It's a pseudo small business because it can become non-passive and I can write off business expenses against it. In that realm, what I want, here's my tip that's a year-end tip as well. I've said in my books for years, look at buying one rental property a year. Even if you go in halves with someone, always be looking to pick up that passive income from rental real estate. I know some of you don't want to be a property manager and plunge toilets. That doesn't mean what it is. You could go into commercial storage units, whatever. But when you set up your LLC for rental property every year or a portion thereof, you're creating future wealth, appreciation, cash flow that's typically tax-free. What's the tip? Do it in your Roth IRA as well. Buy rental property in your solo 401k. Buy rentals in your Roth IRA. Never pay tax again on that rental property, and it just grows and grows. And once you turn 59 and a half, you could sell the rental tax-free, keep taking out rent tax-free. Your Roth IRA should be buying one rental a year while you're buying a rental every year. Build two buckets of wealth. Now, if you're getting that 8% in your ETF and loving it, knock yourself out. I'd rather make 15 to 20% on a rental property in my Roth.
Buy a Roth. Use your Roth every year to buy one rental property, and then you yourself outside of the Roth buy a rental property. So then you can sort of, if you want to live off of the passive income right now, but the other one at 59.5, you're getting that full tax benefit, grows tax free, and you get that full benefit there. Fantastic. Yeah, we've been something that Natali and I have been doing for years.
Yeah, and it's in a perfect world, everybody. I know it's tough. We got to come up with the money and the mortgage and whatever. But if we put out to the universe, I'm going to buy rental property. I'm going to learn what I need to learn. The universe will bring you those relationships, that knowledge. And you don't have to, it's not a race. It's a journey. Don't compare yourself to anyone else. You may buy one rental property every 2 or 3 years, but where are you going to be in 15 years? I love getting rich slow. I hate get rich quick. I love getting rich slow. And rental property is that strategy. And so the tip, if you're going to convert any traditional IRAs to Roth, you have to do it before December 31st. Now, I'll pay a little tax, short-term pain for long-term gain. Because once I pay that tax now on that IRA, I'll never pay it again. It's called a Roth conversion. You can chunk at it, just convert a little bit, and then use that Roth IRA to create an LLC with your family or friends. We have an LLC with our kids, with everybody's Roth IRA in it, and we have a rental property. Rock the races.
And by the way, I should mention, we'll have links to everything that Mark's talking about here. So if you want to work with Mark's team, he can help you do this. He can help you convert that, move that over, set that up as a Roth as well through Mark's team. So we'll have a link on, if you go to redacted.inc/invest, we'll make sure all of the materials are there for you. All right, home run here. We'll get you out of here, Mark. What do you think sort of a final 1 or 2 big tax tips here before the end of the year?
Well, one of them, this is a tip and a cautionary point, and we can finish with this. And let's talk about a farmer. You've probably seen this. You drive around in a rural area, and you drive by this beautiful farm. You get by the barn, and this farmer has a ton of equipment just sitting there. And you're like, what the hell? Well, what happens every December is a farmer who, in their culture, hates paying taxes, is going to go out and buy the next sexiest John Deere because they'd rather buy a piece of equipment than pay tax. They let the tax tail wag the dog. Well, you don't know how many times I've got a phone call on December 31st from a contractor or a realtor. Mark, I'm down at the Ford dealership. Should I buy this F-150 or this SUV? I can bonus depreciate the whole thing off. I can put down $1 and write the whole thing off. Okay, this is for your lecture for your 21-year-old as well. Just because you can do it doesn't mean you should. So people, on the good side, be looking at what expenses you need that you're going to incur in Q1. What equipment do you need to upgrade? Do you really need a new vehicle? Maybe so. New trailer, new this, new that. Small business owners, they're always looking for expansion and scaling. Well, let's pull the trigger in December, even on credit. I can take the tax write-off now and get the use of that tax deduction rather than pulling the trigger in January and waiting a whole other year to write it off. But let's also be cautious and not go out and buy crap we don't need. We don't get 100% tax write-off with 100% tax rate. You only save 30% on that purchase, and then you're sitting there going, why did I buy that RV? Why did I buy, So be careful, people. Don't just go buy stuff to get a write-off.
No, I've always heard that. That's great advice. Like, don't just go buying stuff because you think you're going to get the tax write-off. If you don't need it, don't buy it. You don't need it. So my father-in-law runs a big business in California with hundreds of employees in the landscaping business. And so they're thinking about, like, does it make sense for us to buy this giant digger right now? Or, there's no reason for us to just buy it at the end of the year for that purpose. So great tips. All right. So I encourage you, rewatch this with a pad of paper and a pencil and write down all of these tips. Mark has other great resources on his YouTube channel as well. And of course, we'll link up everything that we just talked about here on the website. So if you want to get in contact with Mark's team, you can set up a Roth IRA. You guys do all of that, right?
Yeah. And the jumping off point would be with one of our tax lawyers. We keep it affordable for small business owners, Main Street America. I've got 10 tax lawyers that my partner and I have trained for the last 15 years. They're incredible. Get an appointment before year-end. We call it a year-end tax consult. And we build a plan for the new year. What do you need to pull the trigger on before year-end? And we're pretty busy. But that's KKOS Lawyers. Links down below. And but just start learning. Just catch me on my YouTube channel. Catch me on my podcast as well. Because the more educated you're on this, you're not going to be kicking yourself in April. Like, damn, So
No, it's perfect because we don't learn this in school. They do not want you to be financially literate. They want you to work for somebody else. So if you can actually be financially literate and become an entrepreneur and own your own businesses and understand your tax strategy, you're way ahead of the game. So Mark, thank you so much for this. Merry Christmas. Keep my stocking hung by the fire so I can get my 1099 and my candy cane. I appreciate it. Thanks, Mark. Great seeing you, man.
thanks so much, Clayton. Have a Merry Christmas.
You too.